After going on an impressive run, shares of cybersecurity firm CrowdStrike are down at some points today nearly 10%, although those losses have paired a little bit, following the company's earnings release after the market closed yesterday. So, what does this mean for shareholders? Is this the end of this surge in cybersecurity stocks that we've seen over the past month or so? My name is Brian Stoffel. We'll spend the next couple of minutes trying to figure this out. At the time of this recording, I do own shares of CrowdStrike, and I want to give a shout out to Fiscal AI for sponsoring today's video. You'll hear more from them in just a minute. So this was CrowdStrike's first quarter ending on April 30th. It is about a $170 billion company. Now, revenue grew 26%. It came in ahead of analyst estimates and management's own guidance. Earnings per share on a non-GAAP basis of $1.10 grew over 50%, beat estimates. Non-GAAP operating profit was forecast for $309 million. It beat that. It came in at $326 million. Now, the rest of these margins are on a GAAP basis, which includes, most importantly, stock-based compensation, but some other things as well. Importantly, gross margins actually expanded by about 130 basis points. Net margins are still negative on a GAAP basis, but those margins improved markedly, and the net margin was actually positive for the quarter. Free cash flow increased by quite a bit, going from $280 to $470 million. Net income swung to a positive. The balance sheet is in great shape, with roughly $4 billion net cash. Now let's go down the income statement, and the income statement does state everything GAAP, so it includes stock-based compensation. You'll see why that matters in just a minute. So revenue was up 26%. We'll get to why that number was actually pretty important in just a minute. But just as important, the cost of that revenue was only up 19%. That's why those gross margins were able to expand. And importantly, there are subscription gross margins, and that's what really matters. Professional services gross margins, we're less worried about that. That's what gets people on board. What I want to point out is just that subscription gross margins, even after you factor in some stock-based compensation, expanded to the point where it's over 78%. That's great news. And so that is what led gross profit to grow by as much as it did. But also importantly, operating expenses only grew 15%, including stock-based compensation. 26% revenue growth, only 15% operating expenses growth. That's why this loss narrowed so much. We did see a swing to profits on a net basis. It is worth pointing out, however, that the total number of shares outstanding did increase by almost 4%. We're going to need to take that into consideration in just a moment. Now, there was a lot more to this quarter than what we can just see on an income statement. And for that, we're going to head to Fiscal AI. If you're an individual investor like I am, I think this is the best tool you can use to improve your performance. It's a tool that I use every day. If you want to use Fiscal AI, click the top link in the show notes below and it'll take you right there. So what I've done is I've gone over to Fiscal, and the first thing that I pulled up here is growth rates for CrowdStrike on a quarterly basis over the last couple of years. And what I really want you to focus on is what happened right here about a year ago, where the growth rates kind of bottomed out at 20% and then started growing again. And there's two big factors at play here. One is that for those that might not remember, a couple of years ago, there's a huge outage that CrowdStrike had, and they had to give concessions to some of their customers in order not to lose them. And some of those concessions pulled back on the revenue growth rate. We lapped that, and what we've seen here is that the revenue growth rate has been increasing. But that's not the only part of it. If you listen to the conference call, the thing that George Kurtz, the company's co-founder and CEO, said over and over again was the mythos moment. Of course, that refers to Anthropic's private Project Glasswing, where the most up-to-date version of Anthropic that hasn't even been released to the public found cybersecurity vulnerabilities in tons of different areas, and it showed how important cybersecurity is going to be in this age of agentic AI. On the call, Kurtz talked about how he expects that there's going to be 90 agents for every employee, and being able to manage cybersecurity for all of these agents is going to be really important. There's a new product that is still very, very, very small called AIDR, which is AI Detection and Response, which grew 250% sequentially. Now, that's only off of about a $50 million pipeline that is currently showing up, but that shows that this is a new area that can drive growth, and we're seeing that revenue reacceleration bump up, as you can see, from the January quarter to the April quarter. So that is really good news for shareholders to see. Another thing that I want to point out is annual recurring revenue, because this is a way of saying, if you take the revenue that you're earning right now and pull this out over 4 quarters, how much are you earning? And we see the same thing here where annual recurring revenue, it bottomed out in July of last year, and that growth rate has been accelerating over the last 3 quarters, coming in at 24% growth. And management said net new ARR growth is very strong in the current quarter. And so that led to them upping their guidance, which we'll get to in a minute. One last thing that I want to point out that we can see here on Fiscal AI is the company's remaining performance obligations. Now here, we did see a step down. Remaining performance obligations is basically money that they will contractually recognize in the future, but aren't able to yet because they haven't delivered that service, usually because it's for time in the future. Now, while that growth rate did fall to 29%, this can be a lot more lumpy, and I'm less concerned about it, especially with CrowdStrike Flex being implemented, which means that companies can increase their spend as they need to. But importantly, what that means is that we don't see as much visibility into that because they can increase as they go along, so it won't show up in RPO. So this isn't hugely concerning to me. It's just something to keep an eye on. What else happened during the quarter and during the response? Well, management came out with guidance. They are guiding for 23% revenue growth in the next quarter. Their earnings guidance shows for 36% growth in operating profits. Both of those compare favorably to management's own guidance. It's also worth noting that management upped its full year guidance. And here's what's important. The company beat the current quarter revenue estimate that they provided by $24 million at the midpoint. But the full year revenue guidance was raised by $40 million, which means that this is a true beat and raise. They beat and then they raised by more than what they beat in the first quarter. So management really sees a lot to be excited about moving forward. So what, as a shareholder myself, am I going to be watching moving forward? Well, first is that net new ARR. It came in at $256 million during the first quarter, and management could not stop talking about how they are seeing some really, really positive momentum here in the current quarter. So they're giving us a viewpoint into this. Second, gross margins, because those are really important. Keep an eye on those because we don't know how that's going to pan out into the future with some compute costs perhaps having to be factored into this. Number 3 is guidance on net new ARR and ARR in general, because that was also revised upwards. Before, management was guiding for $6.49 million in ARR by the end of the year. Now they're guiding for $6.54 million. And that is a meaningful acceleration as well. And finally, you got to keep an eye on dilution because this company is offering up lots of stock-based compensation. There's no doubt in my mind, with AI agents increasing traffic on the web and vulnerabilities through cybersecurity platforms, that the moat is widening and the thesis is very much on track. The question then becomes, well, why is the stock down so much? And the answer to that is simply valuation. Now, to give you an idea of my own history with this stock, I first purchased it back in 2020 at about $90 per share. I've sold throughout that time, but I ended up selling all the rest of my shares in late last year and garnering about a 430% return based on that very first purchase. However, something happened between late December and February, and that was Anthropic coming out with all of their new cowork releases. And that hit me as something that is really important for the future of cybersecurity. So I restarted a new position, got lucky with my timing here in mid-February. However, shares had climbed 68% in just a matter of a couple months. Now, I didn't sell all my shares. As I said, I still do own some shares, but I trimmed roughly half of that position after that basically 70% run up in the stock leading up to there. And I'm comfortable with where my position size is now. Now, if you're curious to follow along what I do with CrowdStrike in my own portfolio, I want to let you know about Stock Investing Mentor. This is a program that I run that has 3 pillars. The first is that you get real-time access to my real-life portfolio and know about any trade as it happens with a full explanation. Second, you get ongoing coverage of all the stocks in my antifragile universe. Those are stocks that I own and on my watch list. And every 5 weeks, you get an update of my top 5 stocks. If I was starting a new portfolio today, what would I start with? And finally, there is live training every week, 1 hour of live recorded training and 24/7 access to a private online investing community. If you'd like to join that for 10% off, click the second link in the show notes below. So why is the stock down so much? Well, the answer is simply valuation. Look, there's a couple different ways we could look at valuation. One of the easiest is just to look at what about some multiples? And I would argue that the most relevant multiple we could look at is forward price to free cash flow, because there's so much stock-based compensation. Forward price to earnings doesn't really tell a story. And look, this company, even after the drop today, is still trading at about 100 times forward price to free cash flow, which is not only really high on an absolute basis, but it's high compared to where the stock has been in the past. But I think the best way to do this is to do a reverse discounted cash flow analysis. And here's how we do it. We're first going to optimize. The free cash flow. Now, management has said before that they believe that CrowdStrike can achieve 38% free cash flow margins. So they aren't there yet, but they believe that they can have 38% free cash flow margins. Well, the company has about $3.4 billion in revenue over the last 12 months. If we gave them 38% free cash flow margins, that would give them roughly $1.3 billion in trailing free cash flow. Again, this is optimized. It's not what they have right now. If we give them a 3% terminal growth rate and a 10% discount rate, we need to make these green and blue numbers match each other, because that tells us how fast revenue needs to grow moving forward. And as you can see, this is going to be a big number. It's not 20%. It's not 25%. It's not 30%. Boy, is it 35%? Now we're getting closer. 34, maybe 33. About 33% revenue growth per year for 10 years to justify this stock price. But we also need to factor in that dilution. Maybe we say 2% dilution per year moving forward. That means now that revenue needs to grow 35% per year for 10 years to justify this stock price. Well, what do analysts think this company is going to do moving forward? Going back to Fiscal, we can actually check this. Here's the revenue growth rates in the past, and here is what analysts see moving forward. They see it being in the low 20s. Remember, I said they need 35%. Analysts believe in the low 20s. Now, the onset of agentic AI could definitely re-accelerate those revenue growth rates. But as you can see, analysts have not been making huge upward revisions yet to this. So what am I going to do moving forward? Well, this, because I trimmed it, is a position that is around 2%. So even today, with it falling roughly 10%, that's only a 0.2% drag on my portfolio. That's why position sizing is so important. That's another part of what you'll get in Stock Investing Mentor if you'd like to join. So those are my thoughts on CrowdStrike. I'm happy with the position where it is. I certainly still think the valuation is still very stretched, even though this company is pretty much doing everything right and has a huge tailwind. Let me know what you thought of earnings in the comment section below, and don't forget to hit subscribe to keep up to date on CrowdStrike the next time they report in 90 days. Until then, Brian.